Thank you for coming.
Thank you. Yeah. Thank you. Well, it's really great to be here. Just kind of a little bit of background, and people always ask, well, how did you end up getting in the real estate business? And so when I came to Florida in 1976, I was a pre-med major, which lasted about a year and a half, and decided that wasn't for me. And so I took a couple classes in the business school, and basically graduated from the business school with an accounting degree. And I was lucky enough to, the year I graduated in 1980, they had just started the master's program for the accounting school. So I had an opportunity to kind of stay another year and got my master's in tax. And then my first job was actually with Pete Mark Mitchell, which is I think called KPMG now, down in Miami. And it was 1981. And our office was involved in real estate tax loss syndications. So the partner was given opinions, and they got me involved in putting together projections and things of that nature. And then, so I kind of got a little taste of the real estate world at that point in time. Thought, well, this is fun. This is for me. I like the transaction side of it. I like to put together deals. So I ended up moving to Denver and getting a job with Price Waterhouse, and my first assignment there was I was doing all the tax work for Oxford Properties, which was a large Canadian developer that was based in Denver. So I was there about 3 months doing their tax return, and after I completed the tax return, they wanted to know if I wanted a job in their tax department. So I took that opportunity and figured out a way to get into the finance group, which was the floor above, and from there, my kind of real estate career has taken off. I look at real estate as, I never look at real estate as a job, but as a career. I really enjoy going to work every day, and I like the relationships I've made over the years. And what you'll find out is that real estate is really a small world. There's about 20% of the people that do 80% of the deals. And it's all about relationships. I mean, people want to lend money to people that they've had good experiences with over the years. Very, very important in the business. And as I was mentioning before, I always view real estate as kind of a local business. You have to know the local markets, I think, to be successful. So today, I wanted to talk about a case study of, give you kind of a real life experience of 3 buildings that we purchased and had to recapitalize because of the 3 Bs, which was kind of weathering the real estate cycles of boom, bubble, and bust. And so I was kind of, when I was putting this presentation together, I was thinking, okay, how far back do I have to go? And it's really, back to about 1980. And I'm thinking to myself, well, I've experienced almost all these boom, bubbles, and busts since 1980. So I have a pretty good perspective on it. So what I want to do is kind of put the case study in context with kind of real estate cycles. And because, not that you guys will be in the position where you'll see 4 or 5 cycles before the end of your career. It always happens, and it's always driven by the same common denominator, which I'll kind of mention. So really, that's the basis for the presentation today. So what I wanted to discuss is just kind of give you an overview of who Titan Investments is, talk about real estate cycles, and then kind of dive into the kind of case study. And I've kind of broken it into a number of different topics. Talk about what our acquisition strategy is when we kind of went into buying office product in the Denver market, how we analyzed the market, and what we looked at as far as from the asset class and the type of asset we wanted to buy. What the Denver market was experiencing that time, which kind of relates back to what cycle we were in the local market. Kind of talk about the building portfolio. Talk about kind of the functionality of the building when you kind of look at it. I don't know if you guys had much experience with, floor plates and kind of dimensions from the window line to the core. What makes a good office building and what makes a building harder to lease. Talk about our initial capitalization structure, and then talk about what happened in 2008, where we had to kind of figure out how to kind of stay in the game and how we kind of recapitalized these properties. And then just give you a little bit of kind of lessons learned from my experience over the last 32 years that hopefully you can take away with you today. So Titan Investments, I formed the company in 1993. And someone asked me in this group meeting we had before, why'd you move back to Denver? And it was because my wife was from Denver. And we decided that we didn't want to raise our kids in Chicago. So we moved back to Denver, and I basically had an opportunity to start my own company. And we've experienced, we do a number of different product types. We've have 4 different platform businesses that we've been involved in over the years. And what I've tried to do is take advantage of opportunities in the market and try to buy when we think there's buying opportunities and sell when we think there's selling opportunities. And we've also done a significant amount of development over the years. Just kind of give you an overview. We were big in the assisted living business probably in the early 90s. Describe this transaction to you. We joint ventured with a company called Sun Healthcare, which was a publicly traded nursing home company out of Albuquerque, New Mexico. They wanted to actually branch out and get into the assisted living business, but didn't have any development expertise. So we joint ventured with them to find the sites, go through entitlements, and then develop the product. But the other key to this joint venture was they want to create a capital structure that would avoid them taking the startup losses onto their P&L because they were a public company. And we came up with a structure that worked for them. We developed, I guess, 8 properties in various markets around the country. We sold this portfolio in 2001. The other business that we're actually still active in is that you may have heard of a company called American Campus Communities. But we were partners with American Campus Community prior to them going public in 2004. We got involved with an equity partner that we were partners with on the assisted living called Bergstrom Strategic Venture Partners. They were the capital partners behind American Campus. And we came on board. At that time, American Campus didn't have any expertise on off-campus development. They did a number of projects on campus for universities. So we put together a program, and we went around and found various sites around the country, and we ended up doing 5 transactions. And we currently have another one, actually, we're not doing with them. I was mentioning a development deal down in Tempe, Arizona, that we're doing at ASU, a 600-bed project. And then we basically rolled our ownership interest into the IPO in 2004 and basically sold out. I remember getting a call from our banker. We had about $100 million worth of construction loans. And he calls me, and he just got a call from his boss and said, we got paid off today, $100 million in one day. You know, it was a bad thing, right? And now, actually, American Campus, I think, is the largest publicly traded student housing REIT in the country. We've done a number of multifamily projects. This is just kind of a sample of some we've done. I put the 2 on the bottom because those 2 are in development. We just got approval on the one in Apple Valley, Minnesota. It's going to be a 322-unit project. We should break ground by May 1st, and then we've got a 250-unit project in just outside of Houston in an area called Sugar Land that we'll be breaking ground with it next year. Our current office portfolio is pretty concentrated in Denver. The 3 buildings at the top are the buildings that I'll kind of talk about today in our case study. The building on the lower left is a great site in downtown Chicago, right at the corner of LaSalle and Monroe Streets. Monroe, and 2 historic buildings that we've had redevelopment plans over the years. We're actually going to develop a 1 million square foot office tower, and the building on the corner is an historic building, so we were going to convert that to a boutique hotel. But it's hard to get a $500 million development deal kind of financed these days. So we're actually just going to renovate both buildings and maybe turn the mid-block building into a hotel. I put those lower pictures down there, Denver Corporate Center and Park Place, just as a note, because when we kind of saw the cycle changing in Denver, those were our first 2 acquisitions in 2005. We bought that building on the right, Park Place, and we bought Denver Corporate Center and then we closed on that 3-building portfolio in '06. So real estate cycles, we've seen them over the last probably 20 years, 30 years, and they go up and down. And really, if you kind of look back at real estate, 1970s was really kind of the start of real estate being somewhat institutional. We saw, the first publicly traded REITs come into play. We saw real estate syndicators doing public offerings, and we saw a demand, especially on the commercial side, for office. So demand kind of outstrips supply. So I would say if you kind of look back over time, the 70s were kind of the point in time where real estate became kind of an institutional product type. And then, we kind of experienced some back-to-back recessions, I guess, in the 70s. And then, Congress enacted the Economic Recovery, I think it's Tax Act, in 1981, which had a significant impact on the marketplace. That was one where they created accelerated depreciation, and all of a sudden, all these people figured out how they could raise money and sell tax losses. And that spurred, a tremendous amount of development because now there's new capital coming into the market. And then it's interesting to see that the S&L industry really was big in lending in that point in time. And we'll kind of see what happened to the S&L industry. I guess when you kind of look at this, the common thread of all these booms and busts are what I would call the herd mentality, is capital. Capital always is funding the oversupply in the marketplace. In this particular cycle, we saw the S&L industry and the syndicators who's selling tax losses. And when you kind of look at that whole tax loss syndication, it really wasn't any value associated. They weren't really looking at value. They were looking at really sheltering people's incomes. So there's money flowing into market that weren't justified by necessarily the real estate or the values. So that was what happened in the 80s. And then the other interesting dynamic was that we had Japanese investors buying up mostly trophy assets in major downtowns, the two coasts and probably the Midwest, at ridiculous cap rates. We did a lot of business with Yasuda and Nomura and a couple of Japanese institutions. When I was with Oxford Properties, we sold a building in Chicago that was known at that time as Quaker Tower to a Japanese investor group that paid like, $350 a square foot for the building, which was like, at that time, a new high watermark for real estate. But, we know it. And then in '86, Congress changed some of the rules. And then, what happened? 1989, basically the market collapsed. The S&L industry collapsed. We saw defaults on banks. And I guess the FDIC set up what was called at that point in time the Resolution Trust Corporation, or known as RTC, which totally kind of collapsed the real estate market at the end of it was like 88, 89, 90, 91. But here again, this was a great buying opportunity. If you were lucky enough to have capital at that point in time, you took advantage of RTC properties. And a lot of people made a lot of money in the market at this point in time in the cycle. 1990s, we were kind of set back by the oil industry. They put they rewrote the tax code, kind of eliminate these kind of, tax losses, so that money wasn't kind of coming in to real estate at that point in time. And basically, the foreign investors, because Japan at that time was actually having their own economic problems, and they basically, were non-existent through the 90s anymore. And then we actually, at this point in time, 92, 97, the market became more institutional. We saw the rise in REITs, multifamily REITs and commercial REITs really kind of took off and have a much better reputation than they did in the 70s because pretty much they were non-existent in the 80s. So we saw a lot of capital coming back in the market. And the other interesting thing about this, you should see CMBS market. And we all know, kind of relate that to today. So we saw the S&L market in '89, and we see the start of the CMBS market in, basically, I think it was like 95 or so, 96. Basically, you know, it was a new market, either on the commercial side and on the multifamily side. Then what happened was, wasn't bad, but 2000 kind of started off a little rocky. Market was ticking along in the 90s, and then in 2000 we had the burst of the tech bubble. Some markets got hit harder than others. Actually, Denver was a market that was hit pretty hard. It was all those internet companies that everybody invested in that thought were going to be the next Google. They were gobbling up space, and Denver must have had, and I can go over this, but 25% vacancy in the market after 2001. We had the terrorist attack of 2001, which kind of hampered everybody's level of enthusiasm and investment optimism in the market. And then actually the market recovered probably 2003, 2004, and then 2008 hit. And the CMBS market was up to $550 billion at that point. And I've experienced all these, and this has been the worst. I mean, it was like one day, the faucet turns off, and no one wants to do anything. I mean, there's no capital in the marketplace at this point in time. It was like, I remember, it was October of 2008, and the market just kind of, at least the capital market, dried up on us. Yeah, really a near freeze. Values started to drop. So the capital markets turned off. And then we saw, the office market, because you had all these residential real estate companies, residential developers, subprime lenders, everyone go out. All this office space kind of came back into the marketplace. So the Denver office portfolio. So this kind of takes us to kind of what I want to talk to you about, and kind of relate that to this acquisition we made in 2006. Our strategy is short-term in nature. We're add-value type players. We like to get in, get out. Our partners that we attract for capital are add-value type. And I say add-value because they're all looking for 20% leverage returns. Our hold period is typically 3 to 5 years. And when I say value add, there's a couple aspects to value add play. It's re-tenanting, putting new leasing in there, bringing the quality of the asset from a B asset to an A asset, looking at a capital plan, whether that be existing mechanical systems, and then also just enhancements to the property to kind of bring it up to the next property level. And there's some tricks to leasing up the property and presenting the property in a way that you can get high rental rates. That's kind of our goal. Just to kind of give you a brief, put this in context, so this is 2004, 2003, 2004. We saw there was potentially an opportunity in the Denver market that potentially had bottomed out in 2004, in our opinion, and an opportunity to buy property in 2005 and 2006. And there's about 4 submarkets, but the 2 largest submarkets in Denver is what's called the Southeast market, which is about 28 million square feet of office. And then there's the CBD, which is 23. Then that's kind of flipped. The downtown market is over 30 million square feet now, but these are numbers based on 2004. So we saw, over 22% vacancy in the Southeast market. We saw CBD at 18%, and those rental rates, just to give you perspective, those are gross rental rates, so they include operating expenses, so your net rates are probably $6 or $7. So it's hard to make money at those rates. So we really saw the bottom of the market in 2004. And then we saw 2005, which we were right, is that we saw net absorption start to turn in 2005. So we saw significant absorption in 2005. And 2006 actually set a high watermark for Denver, that 3.3 million square feet of office space absorbed in the market, which we haven't actually had that number since that point in time. The other thing I didn't mention when I first started, if anyone's got any questions, make this kind of interactive. Feel free to kind of jump in and comment on a particular slide, and don't wait to the end of the presentation. So obviously, we had significant absorption. We saw the market rebound. Let's see. Okay, the building portfolio. We purchased 3 properties, total of 732,000 square feet in one transaction. It was an off-market transaction. The guy I bought it from, I know very well. He was with Shea Properties and didn't want to market it. He just wanted to get a deal done. And when I say off-market, people like to buy off-market deals because you feel you're getting, you may not, but you feel like you're getting a better price because it's not shopped around on a competitive basis. At least our equity partners kind of view it that way. We paid $102.5 million for the portfolio, which worked out to about $140 per square foot, well below replacement cost when you kind of see the type of assets we purchased in 06. So we had it under contract in probably second quarter of 06 and closed third quarter of 06. Just to kind of give you an overview, what we saw, it's great locations. The one property is the CBD. It's called Midtown. It's right on the 16th Street Mall. Great location. The Cherry Creek is kind of a sub-market, not far from downtown, kind of a high-end residential area. It's got the big mall. And what we liked about that particular site was barriers to entry. I mean, you can't find a site in Cherry Creek. And there's been some recent sales. The Janus building, Janus headquarters building, just sold for about $500 a foot in that market. And then the other third building, which I always call the tail on the dog, we got with the package, is this building down in the Southeast Market. It's a great market, the end of the Southeast Market, and we've probably spent more time on that deal, and it's the smallest property out of the whole portfolio. Just to kind of show you, this is the downtown deal. It's a 20-story building. Skidmore Owings design, all granite, great quality asset, great views. So I just kind of want to point this out, what we went into. This is kind of some of the capital improvements we made. We thought the building lobby needed to be upgraded. Great exterior, but it was a little dated on the interior, so we upgraded the lobby. The other opportunity we saw was, I don't know if you can point it out, but there's retail along this 16th Street. And 16th Street is this pedestrian mall in Denver where they have free transit that goes up and down. Those stores, that retail frontage was actually set back about 20 feet. So we thought there was an opportunity to kind of bring that retail onto the street and make it more desirable retail. And we ended up adding about 2,000 square feet of retail, which wasn't in our original numbers, but we're leasing that space at $45 a foot now. So those were kind of some of the add value things we looked at on this particular asset. Just to kind of give you an idea of floor, it's a small tenant building. The floors are about 9,400 square feet. So you would never build this building again. It's just not efficient to build a 20-story building and 9,400 square foot floors. But it has a sawtooth design. And I kind of point that out because when tenants look at space, they look at ratio of window line to square footage. And this building has a great window line, so you get more glass. And those make great offices. And if you can imagine, those offices on the corner all overlook the Front Range. So you can see from Longs Peak all the way down to Colorado Springs. And it really lays out well for a multi-tenant or a single tenant. The other thing we liked about this asset is when you kind of buy an office building is your rollover exposure. We had no tenant greater than one floor, so we couldn't get killed on renewals. This building is the one in Southeast Denver, Meridian, 132,000 square foot building. And this building needed a lot of tend to loving care and still does, unfortunately. So this one was dated. You can see the picture on the left. It was an 80s vintage lobby. It was actually a single tenant building that was converted to a multi-tenant building over time. And the lobby was just kind of felt very 80s. And we wanted to kind of, bring it up. We couldn't do anything to the exterior of the building, but wanted to kind of bring it up. So we renovated the lobby. which I thought came out really nice. And then we also added some other common amenities in the building, which is kind of critical to leasing office property. Most tenants want a fitness center now in the building. They want a common conference room, and also we've got a training room. We had some interior space on the garden level that we converted that to, and it's really been a big hit because for a 136,000 square foot office building, we've got tremendous amenities.
Do the tenants pay a certain amenity fee each month, or is that just worked into their common area?
Yeah, it's exactly. We don't charge a fee for any of that stuff. And the tenants typically can book those rooms when available. Yeah.
Did you close the atrium?
No, the atrium's still there. It's just the way the picture is. Yeah, yeah. What we did do actually was, which I didn't take a picture of, it was kind of always an issue when there's offices along that interior atrium, and people would stack stuff up, and it kind of just didn't look very good. So we end up frosting all the glass, so it looked better when you walked in the property. Just to put this up here, one of the things you want to look at in an office building is bay depths. And what I mean by bay depths are glass line to core. The ideal is 40 feet for a tenant to be efficient because they don't want a lot of deep space. This building, unfortunately, has a lot of deep space, but it works well for an open office user. But you can see the bay depth on that right side is pretty deep. So that's why that atrium. So people will either be along the atrium window or on the glass line. This is actually the third building, the biggest of the three. This is about 420,000 square feet in Cherry Creek. 2 towers that are actually connected by a bridge from levels 2 through 5, or 1 through 5 actually. And what that gives you is pretty big floor plates. When we bought this building, the VA had just signed a 7-year lease, or 8-year lease, for about 140,000 square feet. We've actually expanded the VA. They're currently, I think, about 190,000 square feet in the building, and their renewal's coming up in 2015, so we'll kind of address that. Could be a big value play for us, hopefully. What we did here was we renovated the lobbies. There's 2 cores here connected by a central entrance, and we put about $1.5 million into lobby renovations. This is kind of interesting. We got lucky on this. This building also has about 900 parking spaces under that site. So I highlighted that surface site, and basically we got the surface site with the building, and it was 132 spaces. I get a call from a developer, Fairfield Development, which is a multifamily developer out of Dallas, wants to buy my site. So I said, okay. So I ended up selling him that site for $3 million. And in addition to that, I got 2 levels of below-grade parking under his apartment deal. So we got $3 million. We traded 132 surface spots for 309 covered spots. So it actually worked out to be a good deal for us. My partners loved that. Just to kind of give you an idea of floor plates, on the lower levels, you can actually have up to 40,000 square feet per floor. So the VA kind of likes that big floor plate. On the upper floors, they're about 19,000 square feet, and it actually breaks up pretty well for smaller tenants. So how did we capitalize this deal when we purchased it? So $102 million. We had a couple of different capitalizations. We had a senior loan. Was actually initial funding of the senior loan was $73 million. We put a mezz piece in place. So got us to about 85% leverage. And then we raised about $14 million in equity, 13.5, and the equity was divided into kind of an A and a B piece. Just to kind of give you a brief overview, kind of the terms. So the actual total loan amount or commitment amount was $77 million. So $4 million was future funding, which you always kind of call good news dollars. Good news because they're for future leasing and tenant improvements and leasing commissions. So they were willing to fund additional to lease up the properties. At that time, in 2006, it was a pretty competitive market. We got a great rate on this loan at LIBOR plus 110. It was a 3-year deal, which we had 2 one-year extensions. And basically, we couldn't distribute any cash. All excess cash was going to go pay down the loan. And then we actually, it was a pretty large loan for a domestic bank. So we ended up breaking this loan into 2 tranches, an A and a B piece. And the A piece was a German bank for 80%, and the B piece was a domestic bank. And they had 2 different rates too. Out of the 110, I think the B piece is probably 200, and the A piece was whatever, 50 or 60 or something like that. And then we were able to get a mezzanine loan for $16 million. It was an interest rate of 10% with a current pay of 8.5 and accrued 150 basis points. So that got us to 85% loan to value. The terms were pretty similar, 3-year deal and 2 one-year extensions. Both these loans were non-recourse, only recourse obviously to the property. And I put other than standard carve-outs, and I kind of just put that up. Usually they'll want some type of guarantee for environmental, fraud, and bankruptcy. But other than that, our only security for a loan, they did put a second. The senior lender wouldn't allow them to put a second on the property. So we obviously, which is typical, you kind of do a pledge of your partnership interest as security for the loan. So if you default, they can take over your interest. And then we did an equity joint venture, and it was I'm sorry.
I was just wondering, why did you continue to use the domestic bank if they're only finance the whole transaction, not just
Yeah, they were kind of the lead lender, and they actually brought the German bank in place. Yeah. So we did this deal with an equity partner out of the Middle East that brought the equity. We had done one other prior transaction, actually the Chicago deal with the same group. I just kind of put this up to give you an idea how kind of a promote structure works. So we put in 10%, they put in 90%. And in essence, you get a 90-10 split into a 12, and then you get, this one was a 70-30 to a 16. And then over a 16, we all split 50-50. And then we also got an upfront acquisition fee of $500,000. So basically our $1.3 million we had to put in, I only had to come up with real cash of about $800,000. And the other point, we also manage, so we get management fees, we have construction management fees, and leasing, but we actually do third-party leasing on all our properties. So, okay, 2008, we thought we were doing good. We had a pending sale. We put these properties up for sale. They were pretty well leased at that time. We had made all these capital improvements. And so we've owned them for about 2 years. I think they were all around, right around 90% or 92%. And we had a pending sale. We had 2 or 3 buyers bidding on this thing, and we narrowed it down. And we had a contract out at $125 million. So we thought we'd net, basically our basis at that point in time with cash flow, we thought we'd net $20 million. So that's a pretty good day's work for a 2-year hold. And then the market kind of collapsed. It was October of 2008, and our buyer went away, and we tried to go to the next guy. They weren't interested. So we had to come up with a plan. The market still was good. The fundamentals were okay. I mean, the capital markets crashed, but, the office market was still ticking along. The properties were throwing off good cash flow, and we hadn't lost tenants at that point in time. So we decided we had our first extension, and we decided, obviously, to extend our loan-to-value test. There was some coverage tests in the loan and loan-to-value tests, and we kind of met all those, so we did our 1-year extension. But what we saw in the market was decreasing. The rates were going down. We saw a lot of tenants just go out of business or go bankrupt. We lost a lot of tenants just because of bankruptcy. We saw vacancy rise to 15 to 20%, depending on what submarkets. We saw a significant decrease in property values. But we were okay for a year. And then it was, after we extended, we said, well, we don't see things getting any better here. So we started conversations with our lender in probably first quarter of 2010, knowing we had this kind of looming extension in August of 2010. But the lender was requiring a pay down on the loan. He didn't, his loan-to-value test was 70%. We had got an appraisal now at like $90 million. So he wanted a pay down. And our equity partner, who was having problems all over the world, basically decided he didn't want to fund any more dollars. Okay, so this is a good situation. So we kind of came up with a plan, and we said, well, we're not going to do a one-year deal. And we just told the bank, we're not going to put $2 million in this deal and have the same situation in 2011. So the only thing we would consider is we'll do a pay down, we'll come up with a number, but we want a five-year term. We want to kind of ride this out and see what happens. That was one of our conditions. And then the mezzanine lender, the DPO stands for discounted payoff. It was an insurance company out of Connecticut that we kind of figured there was an opportunity to buy him out at a discounted payoff amount. He had investors in his fund that wanted their money back, so he needed to get some capital back. So that was one of our goals. And then we needed to restructure our equity promote with our partner, because at that point in time, we're into this thing for 4 years already. He's ticking away at a 16% preference, which is kind of squeezing our equity position out. So we felt, part of this is we wanted to capitalize on the new value and get him to a point where we knew we could make money at the end of the day. And then, in addition to that, we needed to raise additional capital to make this all work. And we all had to get this done by August 31st because the loan matured on the mezzanine and the senior lender. So we had to restructure the loan. Okay, so the first guy we had to get in line was obviously the number one guy, which was the senior lender. And we knew at this, his sensitivities were, he was having real estate problems all over the country. Regulators were down his neck. He was having capitalization requirements. They were in good shape, though. I mean, they're sitting there at $65 million with a valuation of $90 million. So, if they would have taken the property back, they probably would have got in excess of 100 cents on the dollar. They just didn't want to take back real estate. And what worked to our advantage with these guys is that the guy in Germany, he didn't want anything to do with it. He didn't want to take, and he was kind of driving the ship. So we were able to negotiate a deal which I think was reasonable with these guys, and I'll kind of show you where that came out. The other guy, which we had a little bit of more leverage on, was the mezzanine lender. Now, mezzanine lender is sitting there with, we're saying, we're just going to give this back to the senior lender. He's going to foreclose. Well, what happens then? Mezz lender just gets wiped out, because the senior lender. So we had a lot of leverage over the mezz lender, and we kind of played that card pretty hard with the guy. We also knew that the mezz lender was trying to sell his paper, so we kind of leaked out to the market that, we were in a position to basically just give it back to the senior lender. So no one else, was going to take that risk that we were just going to give it back to the senior lender. And the other thing we had to put together was we had to work out a new promote structure with our equity partner, so at the end of the day, hopefully we can make some money out of this deal. And then we had to go raise new money. And we had to go find a mezz lender, a new mezz lender, to kind of step into the situation in a capital market that was pretty constrained at the time. So we put all this together with my partners, and we were able to close the deal about 16 days after the 31st. But we actually on the senior lender, we actually ended up putting the senior lender into default because we couldn't come to agreement on the day of the maturity. So they all kind of freaked out, and we got it done probably 2 days later with those guys. So we ended up, his loan amount at the time was, I think, he was down to about $65 million. So he required a $2 million pay down to get us to 70% loan to value. We ended up doing a 5-year deal. We had to pay him an upfront fee of 50 basis points. And then we did a fixed rate deal. you can see the rates we paid back then, and which, given the rates today, and we're trying to see if we can actually pay them off, but we're having a discussion about that now, because there is a prepayment penalty on the loan. But at the time, it's good. I mean, we got coverage on the loan, and it is what it is. It was interest only for 36 months, and then we had amortization after month 30 on the loan. So we had to pay, and in addition to that, we had to set up a $2 million capital reserve for TIs and leasing commissions. And like I said before, it's still non-recourse loan. And that's really what kind of gives you leverage when you renegotiate with these guys, is that the loan is non-recourse, with no personal guarantees. The mezz lender, we were able to pay him off at $10 million. So he ended up taking a $7 million hit, his original loan balance, plus he had the accrued interest of 150 basis points. So he was up to about $17 million. So he took a $7 million hit just to kind of walk away from the deal. We got a new mezz lender in at $13.5 million, which was a 5-year deal. You can see his rate at that time was a little higher than the other guy. We're paying him 14 with 10% pay. And the other thing he took from us, he gets 10% kind of profits percentage in addition to that. And we had to pay him an upfront fee. And he had a make-whole provision, which at the end of year 3 basically goes away. And then we had our partner, and his equity balance with his preferred was around $23 million at the time. We got him to reset his equity to 7.5, so he basically walked away from $15.5 million. We walked away from about $500,000. And we ended up resetting the promote structure to basically kind of just a straight 70-30. So we all get back our money. He gets back his 7.5, we get back 800, and then we split all profits at 70-30. So this is kind of sources and uses. We needed $14.5 million. There was kind of an existing escrow account at the property level. We got our new mezzanine lender, and he had a $500,000 holdback. That's why he was at 13.5. And then we had to come up with another $500,000 of equity. And then, so we had to pay down the senior loan. We had the mezz loan buyout. We had a reserve we had to put up, and we had closing fees. So we were able to basically match up the two here. So this is interesting because our revised basis. So we were into this deal at the point in time in 08, I mean, at about $104 million. This restructure, we're into the deal now for $84.8. We were able to reduce our basis by almost $20 million, which is pretty significant. So we project, based on current cash flow or projected cash flow, based on kind of these cap rates, and the cap rates are kind of based on kind of location of the property. Obviously, Hudson Bay is a downtown asset, so we think we can get 6.5 on existing NOI. Meridian is the suburban property, and that's probably a good trade at an 8, and Ptarmigan potentially kind of a 7.5. Now that significantly could drop from a 7.5 if we're able to renew and extend the VA. We think there's a huge opportunity for us. They want to expand to about 250,000 square feet, and they're willing to do a 15-year deal. And they typically, if they're happy with your property, they're not going to move out. So that's kind of, could be a huge upside for us that's not necessarily factored into these numbers. So we think at the end of the day in 15, we may try to sell actually Hudson Bay and Meridian prior to 15. But we think the net proceeds now is going to be about 140 versus what we thought we could sell the properties for back in 08 at 125. So when you kind of look at that, we think net proceeds after we pay everybody off, we're looking at about $56 million. And then about 16 comes back to the good guys. So we think, through this whole restructure, we think we've increased our proceeds by about $35 million. So I'll come back in 15. and I'll give this same presentation and see if that really came true. Way the market's going now, I feel, fairly confident that we'll be somewhere in that range based on valuation, especially the downtown property.
What was the occupancy like in those buildings before you guys came in?
Yeah, they were probably all in the 70s. Yeah. So that was kind of the add value opportunity, kind of bring them up to 90% and increase rental rates. Yeah, so they're all hovering around the 70s. But the key to that is, so when you're buying kind of add value property, it's hard to get leverage on these things with no cash flow. So, having 70% occupancy, provides some cash flow to get leverage. And that was kind of the key to buying add value assets. So what did I learn from this? I'd kind of break this into two categories, subjective and objective. It's just like anything else you deal with. What were we motivated by? We were motivated by, we want to stay in the game. I mean, we want to protect our balance sheets, but more, we want to kind of live another day. We want to take advantage of the opportunity, from a borrower's perspective. And that's what we did. I mean, that last thing, we devised a strategy to put us in a position where we can hopefully capitalize and, basically sell these as the market recovers. Our capital, they're all about, what's their money, where their money's come from, what's their time horizons. They want to avoid additional risk. And the key I put up there is credibility as sponsor. They want to make sure that the guy they're still doing business with is doing a good job. We were doing a good job. This had nothing to do with our performance. It was really clearly, obviously the market and what kind of returns they're looking for. The lenders, there's a couple of things on that. At this point in time, especially the senior lenders, were worried about their balance sheets. They were worried about regulators. And they were worried about P&L. So they didn't want to take this property back. They took the property back, even though it was quasi-performing, they'd still have to reserve against it. So there was a little leverage with the senior lenders, especially the mezz lender. And then you just have kind of the objective factors, which is, is a debt recourse and non-recourse. And, from experience, I got to tell you, if it's recourse, you have little leverage at that point, especially if you have any net worth on a personal balance sheet. So you want to avoid recourse at all costs. Always non-recourse. No personal guarantees. And whether the debt was underwater. In our situation, if you kind of look at it, neither the senior lender or the mezz lender was necessarily underwater based on the valuations we had at that time. And then, the other thing, too, is you can always threaten they can always threaten foreclosure. You can always threaten bankruptcy. But every state has different foreclosure process. Some states it's easier to foreclose, and some states it takes a little longer period of time. And if it takes longer, then you've got this property, for a 6 or 12-month period, somewhat in limbo. I don't know if you've heard the term, which is the zombie properties, which is a property that you can't do anything. I mean, it's a zombie. Basically, you can't lease. You can't do any capital improvements, and it's just sitting there for a period of time because the owner's getting foreclosed on and no capital can go in. So it just kind of sits there and occupancy goes down. So they're concerned about that too. And just the overall project quality. I mean, all these assets we bought them, we thought they were well located. We think they're great assets. We put a lot of money into them to improve them. So the quality was still there. It was just kind of a market issue at the time. And I guess I kind of wrote a couple things here just based on my experience, is it always bounces back. Market always recovers. Some cycles take longer than other cycles, but they seem to kind of come back. And there's a lot of smart people out there, and they're always coming up with new ways to raise capital and deploy capital. We see hedge funds, which, kind of look back, have just they're going to make a killing in this last round, buying some of these big portfolios, or where people are going to really make money is buying, loans from banks, defaulted loans from banks, like Starwood and BlackRock. And, we always see the seeds of the next boom have started in this cycle. And And we've seen now the hot property type, at least in our part of the country, is multifamily. And we're seeing kind of the herd mentality chase multifamily again. A lot of capital is chasing multifamily. We're seeing compression in rates. We're seeing low cap rates. So you can kind of see, hopefully we're not seeing another bubble, but you can kind of see everybody's kind of chasing the product the same. Because if you think about it, these guys got to put out pension funds, insurance companies, and you look at alternative investments these days, and they're not overly attractive. And they have to do certain allocations to real estate. So there's always going to be money in the pipeline for real estate. Well, I wanted to show you this because that's one of our buildings in Denver. And after we won the '08 National Championship, we flew our flag proud on one of our buildings. And we did it in, I guess, '06 too, twice. Didn't they win the basketball in '06 and the National Championship? So kind of open it up to kind of questions and comments or observations. Yeah.
As a value add firm, when you look to buy a property, what specific factors are you looking at?
I think a couple things. First we want to be comfortable with the market. Is the market kind of recovering? Do we see job growth in the market? And then the second thing is the quality of the asset. What kind of property we're buying. At this point, we're probably not going to buy anything older than 20 years. So somewhere around 1990s vintage because of the capital you have to put into it. And I guess the third thing we look at is location in the market. Is it well located, access to major arteries, that kind of stuff. And then also existing tenant base. One thing you got to be real sensitive to when you buy existing office buildings, especially a rent roll, is credit, because that's really all you're buying is the credit of your tenant. So you really have to do a good analysis of your existing tenant base and what kind of credit those tenants have. Yes?
You look at single-family houses, you think of all the REITs and private equity spend billions of dollars.
Yeah, we don't. And I think people are going to make a lot of money in that market. It seems like it's going to be kind of a management nightmare. I don't know how you kind of administer buying, whatever they buy, 80 homes or 2,000 homes. And, your play is either to kind of rent them out, which seems like a nightmare to me, or just hold them and basically sell. But I think it would be a difficult thing to manage, but obviously somebody's kind of figured that out. Yeah?
What do you think about the different property types going forward, retail versus office versus?
Yeah, we're doing a number of multifamily projects like everybody else, but I think we're developing in pretty key markets. We've got great sites. We're doing a student housing site. I see there's opportunity on the add value play for office. Maybe not as much in the Denver market. We're not seeing add value in the Denver market, but we were talking before, there's some markets in the Southwest like Phoenix, there's good opportunities. I don't know much about the retail, but that's one product type I haven't done. But given all the fallout in the retail market, there probably is some good opportunity in the retail sector.
I may have missed it. What happened to the occupancy in the 3 buildings during the time you were?
Yeah, actually, the one in Cherry Creek, Ptarmigan, actually rode out the storm pretty well. We were basically kept our occupancy up to about 90% in that building. We've actually dropped to about 85% now. And we're actually not being aggressive on leasing there because we want to we're playing, see if the VA can renew. And so we're kind of keeping some vacancy for their expansion. So we're playing that game a little bit. The downtown building, before, in '08, we were getting, just to give you an idea, we were about we were almost 100% leased in that building, actually, which is hard to believe that you can get a building that occupied. And rental rates, we saw rental rates, in the high 20s gross, 29 to 30. I think we signed the lease at like 31 on one of the top floors. And we saw rental rates dive to about $17.50. 12 months, and our occupancy probably dropped in that building to about 80% or 75. We've actually got that back up to about 90% right now, and rental rates have spiked back downtown to $25 to $30. So actually, the rental rates in the downtown market have come back higher than they were in '08. And that Meridian building, I think we had that up into 90%. We probably dropped to 70% in that building. That part of the market was more sensitive to single-family home developers that went out of business and subprime mortgage companies and title companies. And so that building kind of took a hit, and I think we were down to about 65% there, and we're back up to about 85%. Rental rates are still pretty flat in that part of the market. But like I said before, on that particular building, if we can sell it for 13, great. If we sell it for 12, it's in the overall picture, it's not going to make that much difference at the end of the day. Sure.
Two-part question. One, going back, it seems like in the past 30 years, this 10 years, there seems to be an issue where there's a herd mentality, and then somehow the federal government thinks part of Congress must legislate laws to correct or fix some issues, and then the markets will see a loophole in the law, herd mentality towards that loophole, Congress comes back again, and so forth, until you keep speaking on to 2008. The first part of my question is, what do you think is at fault in these issues? Is it the herd mentality, or is it the subsequent laws that were created to sort of mitigate those issues? And second is, what is your country's strategy moving forward, knowing that these cycles keep coming about? How do you integrate those issues into your overall?
Yeah. I think government should learn that they can't outsmart entrepreneurs. Whatever, I've seen it through 81. Every time they enact something, there's a lot of smart people on Wall Street that kind of figure out how to get around everything, or coming up with a new structure too. So, we're gonna kind of see that same dynamic. But this herd mentality, I just don't understand. I think it's just because people need to put out, institutions, pension funds. There's so much capital in the market that they end up chasing a particular product type. Instead of going contrary to what everybody else is doing, the hot product is multifamily, we can get decent returns, we'll put it out. I think the people that are contrary to the herd mentality will always kind of make money. No, we're kind of more, what we've tried to position ourselves is take advantage of misfortunes of other people. Like we take advantage of downturns in the market and then sell when everybody thinks it's rising, like we try to do. I mean, that's why this is a prime example. We saw the market in Denver turning. You didn't see a lot of institutional people coming into the market in '05 because they were nervous about the market. It was more of an entrepreneurial company. We kind of saw the opportunity. We're local in the market. We kind of saw the writing on the wall. We saw that '05 was going to be a good year, and '06 just took off. So what happened, the herd started to come in '07. End of '06, '07, institutions started coming in and buying up properties. So, that's kind of our niche, is to kind of take advantage of those add value opportunities and the swings in the market. And that's what we've done for the last, 25 years. I was mentioning before that we bought a $700 million loan portfolio with some partners with a group down from Phoenix that we ended up with all this real estate, some good, some bad. But some of those development projects I pointed were, as a result of that acquisition, we're able to develop on some of those parcels. Yeah, I think it's a great segment. I mean, there's probably, if you kind of break down multifamily, you have kind of traditional multifamily, and it kind of breaks down to active senior living, which is a huge market, especially with all the baby boomers getting older. You've got the student housing market, same, baby boomers, kids all going to college. If you look at the demographics, they all peak around 2020. And then the assisted living market's kind of huge. And that kind of breaks out, I think, between independent living and assisted living. And I think that market will kind of continue to expand as we've seen it. When we did those, I think the model has changed a little bit since we did them. And the other sector of that market actually is memory care. Memory care is probably a huge sector of that market now. I don't know if you've seen those type of facilities, but memory care product is, probably a total of 40 beds, single story. But unfortunately, that's a huge part of the market. I mean, I actually just saw in the USA Today that I can't remember the exact number, but Alzheimer's, they expect it to triple over the next 20 years. So those are all great sectors of the marketplace. The thing about that market, which we don't have the expertise in, is on the operations side. It's kind of like running a hotel. So you need, especially there's a lot of regulation associated with memory care and also assisted living. So you really need to have kind of the operational expertise or kind of joint venture with somebody that has the operational expertise to run those facilities.
Where do you see the CMBS market going in the future? Do you plan on using it to finance?
Yeah, it's coming back. On the commercial side, it's coming back, and they haven't gotten to the point where they're competing, aggressively on loan to values on commercial product at this point. But I haven't seen the numbers, but they're probably up to like 200, 150 billion, I think, back in the. I mean, it was non-existent, zero new starts and loan initiations probably a year or 2 years ago. So it's definitely come back. I think their underwriting requirements are, obviously more stringent than they were before, but it's like everything else, those will loosen up a little bit. They're good money for, kind of 10-year money. It's the flexibility when you do a CMBS deal. I mean, it has to fit into a certain form. Then you've got some, you got to be positioned to say, I kind of want to hold this property for a period of time because there's some significant prepayment penalties associated with it. But it's definitely a capital source coming back into the market. And we're also seeing, insurance companies come back into the market also as a capital source. So, we see the markets clearly loosening up from a capital, which is good and bad because, people are going to start developing again. We haven't really seen actually much office development or new office development in Denver. If it is new development, it's, pretty much pre-leased or a single tenant building. I think it's real difficult to get a kind of a spec building off the ground these days. Yeah. Yeah, it's just, when you look at an office building, you have to look at kind of the efficiencies of the floor plate, okay? And when you lay out an office, I guess I should mention this. The other dynamic in office is that, the ratio, I think, was one person to 250 square feet, which means that you saw a lot of private offices. That dynamic has totally gone away. People are using less office space per person now. I think the ratio is down to about 100 to 125 square feet per person. And people are going to basically eliminating private offices, trying to be more efficient, and going to kind of a workstation. And we've even seen the workstation evolve. People used to go to an 8x8 workstation. Now they're down to a 6x6 workstation. And the other dynamic is they're actually eliminating the workstation and going to kind of a desk, just a desk in there. I mean, it's unbelievable, the efficiencies of trying to get in office space. And the other thing we're seeing is, telecommuting now, which was a dynamic we didn't see, a couple years ago, is where people work from home now. So they may come into the office, a couple of times. So I think the dynamic of the need for office space is actually significantly changing. And we'll probably see that evolve over time. What I meant by the glass line is when you have a tenant, you ratio to glass to space. So, in a sawtooth design like that one building I pointed out, we had a glass line that is probably 20% higher than if you were in a building that was a square or a rectangle. So that's a real advantage. And the other comment I made was from the glass line to the core of the building, and the core of the building is, where your elevators and bathrooms are. That dimension is usually kind of 40 feet. So when you build, a typical office, an office is 10 by 15, you get your corridor in there, and then you've had some workstations, so you don't have a lot of deep space. So it creates more of an efficient office space because tenants don't want deep spaces. So, those are the things you kind of need to look at and see how you just can't buy an office building, because I've seen office buildings with really inefficient floor plates where you end up with a lot of deep space on the floor, and they're just hard to lease. They don't break up well for smaller tenants. They'll break up well for a full floor tenant because they can eat up a lot of that deep space. So, I'd just be cautious when you kind of look. There's a lot of things in real estate. One is the building efficient? Are you going to be able to lease it? Is the core right? And we'll do, especially on some of these, we've got an architect who does space plans, and we'll do, kind of schematics laying out the floors of doing, smaller suites and larger suites and looking at the efficiencies. And the other thing you got to be concerned about is what they call loss factor, or common area factor on the building, which takes in all your elevator shafts and your stairwells. And that number, for a multi-tenant floor should be like a 15% loss factor. So what that means is that you have, your rentable square footage, the actual usable square footage of the space the tenant's leasing is 100 square feet, let's say, or 1,000 square feet. And you multiply that by the loss factor, so the landlord is able to recover those common areas. So, it depends on the market, but there's a BOMA calculation you do, but you don't want to be out of line with the market. You don't want a 22% loss factor, because obviously the tenant's paying rent on the total gross square foot of his space. So those are all things you need to pay attention to. Well, 15 is a good number for a multi-tenant building. On a single tenant floor, somewhere around, 5 to 8% would be a good number. So you got to keep an eye on those efficiencies. Sure.
Speaking of efficiencies, but I guess in a different light, we've heard a lot of buzz about LEED certification. When you redevelop these facilities, do you try and make them more energy efficient and certify them for LEED?
Yeah. We've gotten 2 buildings LEED certified in renovations. The other thing we've done with all these buildings is that we've got Energy Star rating, which is not actually LEEDs, but it's another, kind of certification that kind of shows you change your light bulbs and all that kind of stuff. That's critical going forward. A lot of these kind of higher end tenants will only occupy buildings that are LEED certified. Pretty much when you develop anything now, you're going to get it certified. It's pretty standard that you can get silver or gold, probably no problem with not much of a premium. But if you try to get platinum, there's probably a 10 to a 15% premium on cost to get to a platinum level. But yeah, I wouldn't see anybody developing any new product, especially on the commercial side, without getting some type of LEED certification going forward.
Do you use the platform auction.com, and do you see that electronic form as a growing marketplace?
I think that thing's rigged, actually. It is rigged. It's not a fair process because we actually bid on a property, and we lost the bid, and then 3 days, and they make you put up, I can't remember, a percentage of the bid, of what the bid price is. So if you win the bid, you've got whatever, $500,000 out part. So we put a bid into a property, and then 3 days later, we lost the bid, and 3 days later, we get a call back. Wants to know if we want the property. I go, well, what kind of auction process is this? I haven't had good experience with it. I think it's kind of an insider deal. That's my personal opinion. I don't think they probably, now this is taped, they'll probably come back to me. But
Could you tell us a little bit more about your company? In particular, how much do you do in-house? What kinds of things do you use third-party vendors for? And then secondly, what kind of positions do you have available for graduates?
Yeah. Yeah, great. So, we like to keep our staff small, actually, and we've been able to do that by leveraging with our partners. On the commercial side, I partnered with a group, Hamilton Partners out of Chicago. And Alan Hamilton used to be one of the original Trammell Crow partners that separated from Trammell Crow, in the mid-'80s and started his own company. They own about 24 million square feet of property in the Chicago market, mostly in the suburban market. I've known them for years. So we partner with them, and what we do is all our accounting on all this whole portfolio, we leveraged off them, and it's done out of Chicago. So we don't have to have any accounting in our staff. What we do have on staff is we do manage, we do all our property management. So we've got a senior portfolio manager, and then we've got property management, property managers at the property level. We have our own engineering staff to operate the property. So we outsource, obviously, cleaning. And we do outsource leasing. We don't have any in-house leasing people, which I kind of argue with my partners on this all the time. But I think for our market, basically 100% of the deals are done by outside brokers. Every tenant that comes through is represented by a broker. And those guys are in the market every day. I think we're giving up fees, but I think it's a more effective way, and it's fair to our equity partner that we kind of put the building in the best light. So we kind of outsource that. We are actually, and then we've got a construction management group in-house to do all our development, and we're currently kind of gearing up that. We've got 2 people in that group now, and we anticipate expanding that piece of it. And the other piece that we're thinking about bringing on is kind of more of an analyst. Kind of initially kind of run numbers, do kind of a jack of all trades now, but basically more of a financial analyst and somebody kind of learn the business. So we are looking for a couple of positions there. And I always like to see Gators' resumes, And actually, got to tell you a funny story. We've got, every time my broker, who's from Cushman, we've got a couple of tenants that are former Gators, so they always get the preferred deal in a couple of our properties. So.
As it should.
Yeah, as it should be, right? Exactly. Yeah.
So you have, your strategy to some extent has been to take advantage of people's mistakes. What are you going to do when they don't make any more mistakes?
Yeah, I just have a feeling that's never going to happen. Yeah. I'm not going to be around for much longer anyway, so hopefully I don't have to do this much longer. Yeah.
It's almost you love your job.
I do love my job. I'll probably always do something. I'm, to be honest with you, I'm kind of a deal junkie. I think most people kind of in real estate are. I mean, you get the thrill of kind of putting the transaction together, kind of negotiating with all these players, the kind of stress of trying to get it done, and that's really kind of gets me going in the morning. I mean, that's the fun part of what I do. If I had to go to the office every day and kind of review financial statements, I don't think I'd last. What's that? Yeah, I think there's opportunities, in select markets for office product to still buy at a significantly below replacement cost. Phoenix is one market. I'm not that familiar with the office market in Florida as much as I am with the West, but Las Vegas is an opportunity on the office side. That market hasn't totally recovered. And then there's certain parts of Texas, like San Antonio, those markets. I think there's opportunities to still kind of buy on the office side.
So you see that market coming back in spite of the reduction in space per employee?
Yeah, that's a dynamic that's hard to gauge. I don't know if you've kind of tracked that as far as companies taking less space and the whole telecommuting thing and just trying to live with less. And we even seen large, basically even law firms actually aren't doing private offices anymore. And they've actually, given technology, reduced their assistance. So I think that's going to actually have a significant effect on the overall office market. I just don't know, how that's going to play out. Because we see people take less space. And now the problem with that actually is especially with these older buildings, is then you get a parking ratio that's not consistent with the tenant. And we've had that issue. So a tenant wants to take, X amount of square feet, and they're packing these people in. It's really like a 5 per 1,000 parking ratio. But the building, most of these older buildings were designed at a 3.5 per 1,000. So what you run into is kind of a parking problem of how to kind of accommodate kind of this new type of tenant that you have to deal with in the future too. So that's one thing you should kind of look at if you're kind of acquiring new real estate, is how you're going to deal with kind of the overall parking ratio. I mean, if you're building a new building today, you're going to build, 4 per 1,000, especially in a suburban market, or even 5 per 1,000. But then you got to kind of weigh the cost of that.
I was really interested in hearing about your international equity partner at 90% share in your joint venture. Just wanted to get ahead of why was that structure chosen? Was it for lower risk or your end? So risk or more risk potential? Was it just who's like and how did you resolve the management partnership? Since you had 90%, they still give you more of this say because you were both partners. And also, the last question about that is how has that strategy overall worked for you? Continue to use it or use it over properties?
Yeah. That's what we did is really kind of a typical equity structure, whether it's done with this group out of Dubai or an insurance company. Usually these guys want to place money with a sponsor and who has a good track record, who has a performance record. So that deal, whether it's 90-10 or 80-20, as far as equity put in, that's a typical structure you'll kind of see in the market. We've done deals at 95-5 equity. But they want to make sure the sponsor has some, something in the game, so they got something at risk. And then, as far as how the promote structures work, those preferred returns have come down significantly from when we did that deal. I mean, you could do a 90-10 deal now and, probably get to a 12 and then split 50-50. So what we did is really not anything different than kind of a typical deal in the marketplace. So you'll kind of you'll kind of play around with the amount of equity contribution. You'll play around with the promote structure as far as kind of your preferred return to the equity. But usually you can get the sponsor will get fees for property management, leasing, even some fees for accounting fees, and then usually they'll want the sponsor to kind of put up some of the guarantees on the carve-outs. But what I've showed you is pretty much a typical deal that pension funds or insurance companies or even just private equity guys will do. What's that? A 90-10. Yeah, so if there's a capital call, it's a 90-10 capital call. We'd have to put in 10, and those guys would have to put in 90.
Just curious, in today's business environment, when you're dealing with this kind of money, whether it's a restructure or a new deal, are these negotiations done face-to-face, or are you guys do a lot of this on a golf course, or how's this tend to be on?
Yeah. Both, actually. On this particular deal, the domestic bank was in Denver, so we had a lot of those. Everything else was pretty much done on the phone. No, it was all done on the phone. I'm not even sure it was all done on the phone. We didn't really met face-to-face with our actual partner or the mezz lender. Now, they may have come out to Denver at some point just to kind of touch and feel the real estate, kind of see what they're getting. We probably met face-to-face once, but most of it was done on the phone. Some late nights and stuff like that.
You talked about a $750 million portfolio that you had purchased. I was wondering where you had purchased from. Was that a bank that was?
It was actually it was a hard money lender that basically had raised money through individuals put in $50 to $150 to $500,000, and they had 5,000 shareholders. They weren't public, but they had to do SEC reporting because they're over 500. And had a decent portfolio, but basically they had $700 million in assets, 77 loans, and every loan was in default. They didn't have any debt, but they didn't have any operating cash flow to kind of keep the company going to dispose of the assets or figure out what to do with the assets. So we saw an opportunity to kind of, it kind of gets a little ugly too because there's a bunch of lawsuits that all these shareholders were suing the company. So we're kind of, my partners are kind of working through that issue. But we think at the end of the day, there's some real good real estate, which we were able to capitalize on and develop. And then also the strategy there is there's about, I think, $700 million in tax losses. So we're trying to get the company back on track and go public as a C Corp and utilize those tax losses to our advantage and kind of become a lender again. And then also the ultimate strategy is to become this company would be kind of a multifamily developer. We're actually in the process, my partner's in the process of buying a 14 property multifamily portfolio to seed this thing. So hopefully it works out. But that was an opportunity, that was a deal was done probably 2 years ago, kind of take advantage of that.
Where's the Titan equity come from, investment partners?
Yeah, actually. So it comes from me. I put my own money into all the deals on the Titan side.
Where do you see the interest rates going in the future? How are they going to affect the market?
Yeah. I don't know. I kind of read something on the plane that Goldman Sachs put out, and they think interest rates are going to be basically static for the next 3 years. They think that once we see kind of, I guess, unemployment go down and kind of inflation, then we'll see the Fed make an adjustment. But their prediction was actually pretty flat on interest rates for the next 3 years, which would be great for real estate. That's the one thing that probably makes us the most nervous is a rise in interest rates. But on the other side, usually if we get a rise in interest rates, we're going to come along with some inflation. So hopefully, that corresponds to, greater rent growth. Maybe it all balances out until you get to a point. But, we're seeing significant compression in cap rates on multifamily. I mean, in Denver, good quality A products selling at, sub fives, 4.5 on a cap rate. Some pretty big numbers. But, it's kind of like what's people's alternative. You got to look at alternative investments and returns, and if you can get a 4.5, I guess that's good these days, So that's kind of my prediction on that.
I noticed that you're heavy in the building market. Do you notice any other markets around the nation that are covered or up and coming?
The one market we're focused on is Phoenix right now. Yeah, we're kind of looking at Phoenix, but and we're still, trying to pick and choose and see. We'd like to buy some more stuff in Denver. We just haven't really come across the right deal quite yet. So we might make some more acquisitions, but we've been kind of shifting a little bit to kind of more of this multifamily development at this point. So we'll probably be kind of busy with that. We've got about 4 or 5 deals kind of in the pipeline on the development side.
Anything else? Thank you.
Well, thank you. It was great to be here.